In this video, we'll be going over how to calculate taxes on the sale of a vacation home or a second home. So this comes from a taxpayer question, and we actually have some numbers that he gave me to help with this case study. I'll point out situations in which I took liberties and kind of filled in some numbers of my own, but we'll walk through this from the case study perspective, what we observe, and then finally how we report this on the tax return. So let's go ahead and take a look at the figures. So our client purchased the home 5 years ago for $800,000. He made $100,000 of improvements, but in that he also mentioned that most of the improvements happened to be furniture. He didn't specify how much was furniture. So for this case study, I included $50,000 for furniture costs, and then the other $50,000 would be some sort of a capital improvement typical of what you would see in a home, a kitchen renovation, a bathroom renovation, something that would actually be considered an improvement. Purchase, when he bought the house, $10,000 of buyer's closing costs. It's never been rented or used for business. He sold it recently for $1.6 million, and that included a typical 6% broker commission and $150,000 of closing costs like transfer taxes and things of that nature. So really quick, some observations. This doesn't qualify for the Section 121 tax exclusion. The typical, if you've lived in your main home for 2 out of the past 5 years and you've owned that home for 2 out of the past 5 years, then you could exclude up to $250,000 of capital gains. Or if you're a married couple and you both meet the requirement, then you each get to exclude $250,000 for a total of $500,000. So we're not eligible for that. So we're going to have to pay some capital gains tax on it, but we'll see how much. However, we did hold it for a long enough period of time to qualify for long-term capital gains treatment. Again, this is, long-term capital gains are taxed at a preferred tax rate over ordinary income. Since it was never used for business, either as a rental or as an office, there's no depreciation that we have to recapture. So generally speaking, if you take depreciation on part of your house because you used it as an office, then you would have to recapture that depreciation when you sell it and then turn around and pay the tax on that. So you can't add the furniture cost to your tax basis. We'll talk a little bit about that. He and I did go back and forth. I think he's got guidance for his personal situation, but we'll talk a little bit about what you could do with the furniture, what the IRS says you should do, and then kind of the guidance in between. And then finally, this is going to go on IRS Form 8949. If you're selling your primary residence and you're able to exclude the gain, you don't have to report it at all. There may be situations where you could report it directly on Schedule D, but because he received a copy of Form 1099-S, the instructions say you have to report it on Form 8949, which will then transfer the results over to your Schedule D, and then from there it will land on your tax return. So let's take a look at the calculations. There are two basic things that we kind of need to understand. So we need to understand the basis. The basis starts off with the purchase price of the house, any improvements that were made, and again, not the furniture, that is considered personal property. So that is not part of the real estate. If it conveys with the house, then the IRS generally won't be particular about going through every single detail to try and claim it. Now, technically, you are supposed to report any separate sale of personal property on Schedule 1 as other income. And then that would be subject to ordinary income. Basically, if you had a deal where you were planning to take the furniture and then the buyer convinces you to add an addendum to your contract that says they'll pay an additional $10,000 for your furniture, and you agree to that, then that $10,000 is a captive transaction that probably would get reported and probably needs to be reported as, the sale of personal property. But if the sales contract basically says $800,000, you go back and forth, you modify the sales contract so that it says $810,000, then depending on how the contract is written, if there's no mention of the personal property, then there's a little bit of flexibility in how to report it. Now, each situation is dependent, and I cannot prescribe advice that's universal for every single person, for every single type of situation. Clearly, the IRS guidance, when it's documented as a separate sale of personal property, it's pretty clear how you should report it. But there could be times when it's not clear, and instead of prescribing a method one way or the other, I would just offer this consideration. If you report part of a sale as ordinary income on Schedule 1, which the IRS instructions require you to do, then you would be paying most likely more tax than if you reported a sale as a capital gain. Again, we go back to capital gains are generally treated with preferred taxation rates. So, even if you can't include the cost of the furniture, if you end up realizing a sale because your furniture is, it's part of the package deal, you've separated it. Maybe the furniture came with the house and you were going to take it with you, but they decided to convince you to leave it in the contract. If it's specified in the contract, then the IRS is very clear in how you should prescribe it. But if you just kind of agree to terms and throw everything in there and it's all part of the real estate contract, then there's really no way that personal property gets separately reported to the IRS. So take that for what you will. So the calculation on the basis is the $800,000 purchase price plus the $50,000 in improvements plus the closing costs. That's $860,000. So that's the basis. And I usually tell people when you try to determine your profit, you're calculating your basis, and then you're trying to see what you can what things you can add to your basis so that the basis is higher. And then you're trying to see what expenses you can subtract from your sales price to lower that gap. So it's kind of helpful if you think of the difference between the basis and the realized gain, and just know that you're trying to shrink the difference to minimize your profit. So we've increased our basis as much as we can on the back end. Let's see what we can back out of our revenue. So we've got the $1.6 million. It did say that we paid a 6% sales commission. So that ends up being $96,000. He also told me that he had $150,000 of separate closing costs. So those are all adjustments to the sales price. And then when you subtract the basis, we get $494,000. So what that would look like if we filed IRS form 8949, we would get this. So first of all, we're on part 2 because that's the long-term transactions. Part 1 is short-term transactions. So make sure you're completing the correct part of the form. We're going to assume taxpayer's name and information is at the top. You must check box D, E, or F below. I would check F, mainly because you didn't get a 1099-B. That's a brokerage statement, and you didn't get anything that showed your basis being reported to the IRS. So I would check F, and then I would just write sale of a vacation home, date you purchased it, date that you sold it. You'll notice here that these are the gross or the net proceeds after those costs. I would do that. Then the cost or other basis, I entered that in here, and you get the difference here. These adjustments to your gain or loss, there's an entire table of adjustments, but I didn't see anything in the instructions for adjustments to basis when it comes to improvements or anything like that. So, but that's how I would report it. If that's the only thing you sell, you can add everything here, and then you would include that in Schedule B or Schedule D in the appropriate line. Looks like line 10. So that's how I would calculate the sale of my second home, and just understand that you would pay some capital gain. Now, if this was your primary home, you'd be able to exclude pretty much all of it. And then, to go back to, if we missed this realtor commission and this ended up being an extra, let's just say it was $592,000, then you would actually have to be reporting this on Schedule D anyway, because now you're reporting a gain that you can't exclude. So a couple of things. One, keep all your closing documents from when you buy and sell your house for purposes of, if nothing more, you just give all of that documentation to your accountant or your tax preparer, and they will research the basis, and they will help you construct what the basis, what the actual realized gain is on the sale of your house. And then reporting it is relatively straightforward on your tax return. So I hope this helped. We'll put links in the show notes to resources we've created about some of the forms and articles mentioned in this video. But so if you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. Sorry. And if you have any questions or comments, or if there's another topic that you'd like to see in an upcoming video, please hit me up in the comments section. Thank you very much, and have a great day.